Hey everyone, this is Terry with Futures.io, and as always, I would like to thank you for joining us today. Now, it is my pleasure to welcome back Kevin Davey for today's webinar, Lessons Learned from the February 2018 Meltdown. If you have questions during the webinar, please feel free to type them into the questions box, and we'll do our best to answer them at the end of the event. If you're watching us on YouTube, please do us a favor and give us a thumbs up if you enjoy the webinar. And as always, please feel free to share, comment, and subscribe to the channel. It really helps us a lot. For trading news, events, and information, follow us on Facebook, YouTube, and Twitter using @Futures.io. And now, without further delay, I will hand it over to Kevin, and you should get the pop-up to share your screen. Okay, looking good.
All right, perfect. Thanks, Terry. And welcome, everyone. And thanks for taking time out of your day to watch, especially if you're in a weird time zone. I'm in Eastern time zone, so it's only 4:30 for me, but I know some of you are in Europe or in Asia. And so it's kind of a weird time for you, so thanks. And of course, I'd like to thank Big Mike and Terry and Futures.io for putting this on. A lot of these things, a lot of these events are really good. Hopefully, a couple days ago, a lot of you got to listen to Adam Grimes, and because I listened in on that. There's a lot of great webinars, a lot of great education. So thanks again to Futures.io for putting this on. So today, I'm just going to briefly go over who I am for those of you who don't know me, and then we're going to talk about what I'm calling, for lack of a better word, the February 2018 market meltdown. Although it was kind of short-lived, it looks like it's coming back. The stock market's coming back to levels it was before. It was pretty dramatic. So it might have really affected your trading, and you really want to take a look at what it did and what you learned, and kind of analyze your trading and see how you can improve. And then we'll follow it up with some questions and answers. So first off, since I probably will be showing some equity curves and that kind of thing, I just want to make sure everybody knows the disclaimer of don't trade with money you can't afford to lose. Any results are all hypothetical. A lot of good stuff in this disclaimer. So take some time and read it when you get a chance. So for those of you who don't know me, I'm going to go through this pretty quick. I'm a full-time trader. I've been trading about over 25 years. A combination, most of that was part-time. Last 9 or 10 years, I think, has been full-time. I was able to make that leap from part-time to full-time. And I finished first or second place in the World Cup of Futures Trading Championship 3 years in a row. So I was able to do pretty good in this trading contest. And I wrote a book. It's called Building Winning Algorithmic Trading Systems. It sounds a lot more daunting than it actually is. I try to make it pretty simple, and it's gotten some really good reviews, and some people in the industry have some nice things to say about that, for which I'm really grateful. And speaking of this book, to kind of encourage people to stick around to the end, I'm going to give away a copy, and I'm going to autograph it and send it. And even if you're in Antarctica, as long as they have mail service there, I will get you that book. So you just have to be quick with an answer to a question at the end. So stick around, and if you don't have the book, or if you just want my autograph for some reason, I don't know, maybe. The other thing I do is that I just run an online class. It's called the Strategy Factory Workshop. So just in case you kind of see what I do and you kind of like it, it's something to consider. So, all right, so that's enough about me. Let's talk about the 2018 meltdown. This was a daily chart as of a couple days ago. And you can see, for months and months, the ES, the mini S&P, was kind of going up pretty nicely. It had a few little scares, and then all of a sudden, just out of the blue, really, this big scare that just plummeted down, and then it bounced up and was rocketing back and forth. it was pretty severe, and a lot of people were unprepared for it. And a lot of people said, "Hey, it's long overdue." You heard probably people talking for months of, "There's going to be a correction. There's going to be a correction." Well, people have been talking about that months, probably years, and nothing had really occurred. And then all of a sudden, this just came, and there really wasn't any dramatic news. There was no, say, like terrorist attack or some kind of central bank thing or anything along those lines. It just happened, and it was pretty bad, and uh, it obviously spilled over to other things. Here's the VIX, the volatility index. It kind of went crazy. It had been so long in a low volatility region or regime that people were just kind of used to it. Oh, hey, maybe this is the new normal, that stocks aren't too volatile. And the interesting thing is, I've noticed, in a couple other traders I've talked to, we've noticed for the past year, 2 years or so, that it seemed like almost all markets were like this. So it wasn't just necessarily the stock market, but things that normally had bounced around a lot more, maybe like the euro and those kind of things, now all of a sudden were low volatility. So this, you can see from the volatility index, it went on the 29th. I don't even know what number this is, somewhere right over 10. It went up to like 50. So it went up a ton quickly. And so if you weren't prepared for it, this could have really hurt you. And a lot of it stems from people just getting what I would call complacent. So I found this quote. This was written by a guy who, you might have heard his story. He was some kind of manager at Target department, the discount stores. I don't think he was a store manager, but he did something there, some kind of management. And he decided to leave because he was doing so good selling volatility. And I found this that he wrote back in March 2016, where he said it's literally impossible for the price of this index, which is a reverse volatility ETF. It's impossible not to erode, and it's 100% certain. And certainly, if you look at it, it was certainly trending that direction. So, in general, he was pretty much right, until he wasn't right. And when he wasn't right, it blew up. So you went from in early 2018, it was down in the 8 or 9 range, and it went up to 30 in one day. I mean, that's kind of scary. And that just kind of represents what we were dealing with, or what a lot of the mindset of people. Stocks always go up. Volatility is always going to be low. Oh, yes, we live in a great new world kind of thing. And, it's funny, having done this for so long. Well, I guess funny is probably not the word. It's sometimes painful, but the market tends to want to remind us every once in a while that, hey, don't get complacent. Don't get overconfident. Don't think things are changed forever. It throws this kind of monkey wrench into things. I saw this story, and this is really kind of sad. There was a guy who said he's lost $4 million, which basically he had built up over 3 years. I think $1.5 million was not his own, but the rest was his. So he took $50K, turned it into $2.5 million, and then you can see he lost $3.7 million. And we could talk about why, and that's kind of what we'll be hitting on. But I mean, basically, if you take a look at what he's in most of this portfolios in this XIV, which is a reverse volatility ETF that basically, I think today was its last day of trading. They just said Credit Suisse decided just to liquidate it because they hit a certain number and it was in their prospectus that said, hey, if this happens, we're done. That's what happened. But this guy lost a lot of money. And probably most of the traders I've talked to, I've only talked to one that would admit to making money. Everybody else said they pretty much lost money due to this event, myself included. And it always seems, what was happening to most people is the market went down, stops got hit, and then they might not have gotten back in. They might have been afraid, or maybe their systems didn't get back in. And so even if the market comes back to where it was, they're still down overall. So it seems like a lot of people lost. Obviously, not everybody lost, but there's really no shame in saying you lost. I mean, and that happens. And I can go back personally to a lot of big events. If you recall, when Donald Trump was elected, the market went crazy that night, and I lost a bunch of money and then slowly made it back. And then during Brexit, I lost money, and that one was quicker. I think within a week I'd made all my money back plus. But the point is, there's all these market shocks, and a lot of times you're just on the wrong side of them, and it's something you really have to deal with as a trader, and it's not always nice. There'll be times where you're not on that side, which is really cool, but it seems like the ones you remember are the ones where you're not on the right side. And like I said, there's really no shame in that, as long as you take away some lessons and you improve from it. The worst thing you can do is have, hey, you lost 10%, 20%, whatever the number is, due to some event, and then you just say, okay, well, I'll just keep on going. No, the market's telling you something. It's saying, hey, Joe, Bob, whatever your name is, you were doing something wrong. Take a look at it, analyze it, see if you can improve. And it doesn't even necessarily have to be the wrong way, right? You could have made a ton of money. It could have been instead of a meltdown, it could have been a melt up. That's not even a word, but you know what I mean. So there was this hedge fund in Denver who apparently predicted this volatility event, and they had a $200,000 bet, and it turned into $17.5 million. Nice. That might be, for most of us, if we were in that, we'd probably say, hey, game over, just take your money and walk away, which is probably a good idea. But you could have actually had a real good outcome, but that doesn't mean you shouldn't analyze it. Well, why? Well, if you think about this particular bet, hey, this would have been great if you already had a multi-million-dollar or bigger account. And, the $200,000 was a very small portion of it. But, would this have been that great of a trade if you had a $250,000 account? Well, the outcome was good, but the whole idea of getting into a trade risking $200,000 when you only had a $250,000 account, that would have been a terrible bet. And remember, you might say, well, wait, it made $17.5 million. That was a good bet. Well, there's a difference between a bet before you know the outcome and when it's afterwards, right? And in this case, you shouldn't be betting $200,000 if you only had a $250,000 account. You're basically saying, I'm certain of this. And it just showed you a little bit ago what the person who said he was certain of something, what happened to him. So the big question with all this, when you start to look at how you fared during this event, the real big question in my mind is always, did you follow your plan? And, depending on the way you trade, you either followed it, you didn't follow it, or you're saying, what's a plan? You might not even have a plan. So you might just be trading and you don't have a plan, which that's probably a topic for a whole nother discussion, but you should have a plan and you should follow it. And as long as you did that, then you're good. But what most people end up doing when these big events come up, they don't follow their plan. And that's a big deal. So if you didn't do that, if you didn't follow your plan, you need to figure out why you didn't. And then if you did follow your plan and maybe the outcome wasn't so good, you need to take a look at that. Maybe your plan needs to be improved. Maybe your plan's fine and you look at it and you say, you know what? Yeah, I lost some money, but there's nothing I would change. Okay, well, that's a perfectly logical decision. But the point is you're looking at what's going on and you're seeing, is there room for improvement? You don't make a change just because you lost money. I mean, we've all been there, right? Where we've created a trading strategy or something and it doesn't do well or has a losing trade, and immediately you think you have to go and fix the system to eliminate that trade. That's not what we're talking about here. We're talking about something bigger where you look at your trading as a whole and say, wow, did I have some weak points? This would be sort of similar to any kind of sports team that after a loss, they went back and looked, hey, okay, did we do the right things here? Maybe we need to make some changes. Maybe we need some different players, that kind of thing. You really got to look and see if you need some improvement. And that's what we're going to focus on today. So, to me, it's a whole different world if you didn't follow your plan. That probably involves a lot of psychological type things, because if you had a plan and you said, oh, I'm not going to follow it, you really got to understand why, and that's a whole different issue. So I'm more looking at it from the point of view of people followed their plan and just got a bad outcome, and what do you do there? And so really the process I show today, you can use that to both improve your plan, but you could also take the generic steps and figure out why you didn't follow your plan in the first place. So you could probably do either. So this comes from quality assurance, continuous improvement, whatever you want to call it. My background before full-time trading was in aerospace, and one of the things I did was I was in charge of quality assurance for an aerospace manufacturer, and we made parts that if the parts failed, the aircraft engine, these were jet engines, would stop. So it was basically a flight critical part. And one of our big things was always what we call continuous improvement. And it has 4 basic steps. You plan, do, check, and act. And so I'm going to kind of follow that and walk you through what you should be doing when you look at your performance over this first week and a half of February. And I'll give you some examples using some of my own results and that kind of thing, but at least it'll get you thinking, hey, this is good stuff. This is stuff I got to do to improve as a trader. Because what you don't want to do is be like this guy, where, hey, I lost money and just ignore it. I'm just going to ignore it. I'm going to pretend it never happened and just kind of go on with life. Um, Not a good way to go. Uh, yeah, it's kind of hard. Trust me, going through this, if you really do it right, and if you lost, a significant amount of money, it's hard to do. It's hard to put what you thought was a good plan under the spotlight and say, ooh, maybe that wasn't so good. Um, but I think you really need to do it. Don't want to stick your head in the sand. And one way to look at it, because people always, oh boy, I don't want to think about it. Think about it as market tuition. It's your tuition for learning to trade and to get better. And that tuition's always going to be there. Like I said, I've been trading 25 years. I'm still paying tuition. And I wish I'd graduate at some point, but I don't think anybody graduates, to be honest. I think everybody at times has things that go wrong, struggles and that kind of thing. And you can either just brush it off, you can ignore it, or you can say, well, hey, this is a learning experience. I'm going to try to learn here how to get better. And so that's the way I kind of always look at this is okay, well, am I really doing things the way I should be? Maybe I can improve. So with that, that would be step one, would be plan. Take a look at what happened, identify your weak spots, and then figure out what you could have done better. So when I show a microscope here, obviously you're putting your results under a microscope. And like I said, you could do this. I think it's easier to do it when you had a bad outcome, because then, chances are there might be something you could fix. But maybe you went through that whole meltdown sequence even, or you made money, but still doesn't mean that you didn't have some weak spots, and maybe there were things you could have done better. So here's how I'd start it. Write down the amount you lost. I lost X dollars. For me personally, I had losses that got hit on long positions, okay? And sometimes multiple times it was loss and a loss in most of the stock indices. At the same time, I had a bunch of gains from being short crude oil and unleaded gas. So that kind of helped out, but at the same time, overall, it was a loss. And so when I look at it, say, hey, where did this come from? That was it. And you could say, oh, well, hey, it doesn't take you long to figure that out. Well, no, it didn't. But the point is, I sat down and I figured it out. So, and that's because that would lead to, the next part. I also looked at my emotions during all this, which obviously all of you should too. Did you stick to your plan? Did you keep strategies running, or did you panic? Did you turn stuff off? I looked at it. I would have been much better just as soon as things started to go haywire. I would have been much better just to turn things off. But I didn't, because that wasn't part of my plan. Now you could say, well, hey, your plan sucks. Excuse my language, and maybe you have a valid point. Maybe I should put something in there that if something goes really nuts, I just turn everything off. But the point is, I did not have that at the time, so I kept everything going on. Okay, so I know where it happened. I know, okay, the stock market went down, energies went down, but energies was okay and everything looked okay. So why were my losses bigger than I had hoped for? So, and this will be something you'll have to ask yourself, why? Why did this happen? So for me, I came up with three things: sector balance, correlation, and long short balance. And you might say, well, what are those things? Okay. Um, they're all things I identified when I did this, when I objectively looked at what went right and went wrong. So I tried to, so my point here was to detail what went wrong, where I think the problem was. And that's all in this first step. And so this kind of wraps up this first step, okay? Then you kind of move on to the second and third step. And I'm putting them together, just it makes it a little bit easier to talk about because they are kind of combined. Because what you want to do is you want to, once you've figured out what happened, you want to come up with some ideas, some solutions of how you can prevent it, and then put that into practice and how you would do that. And so a lot of this check and do in this case kind of becomes the same thing. The problem with it that a lot of people do is sometimes they get a little too cute, for lack of a better word. They just dig a little too deep and come up with things that don't really make sense. And like an example, you could say, well, oh, this was on a Monday when I lost most of my money, and oh, Friday dropped. Or you could say something like Friday was an odd numbered day, so therefore I'm not going to trade on Mondays anymore, and that should get rid of it. Well, that might be getting a little too down in the weeds, too detailed, because the next time is going to be different. You could have come into this event saying, hey, anytime I hear about a big central bank action, or the Fed doing something, or some kind of terrorist event, I'm going to exit all my stock positions, because every time those kind of things have happened, stocks have dipped, and so therefore I'm out. Well, in this case, something different happened. None of those things really happened. There were probably some little news things, but no dramatic news. My point is, it's always different. It's never the same. If you go back a few years to when the Swiss bank had the peg on the Swiss franc, and where it was pegged to the euro, where for years it was pegged and people were making tons of money by betting on the peg always being upheld, until the day where the Swiss bank said, no, we're going to drop that peg, and that market just went haywire. Well, chances are that exact thing's never going to happen again, but I can pretty much guarantee somewhere down the road there'll be another currency shock that will probably be pretty similar. So you got to watch out about any kind of solutions you come up with, because the next big shock isn't going to be like the previous one or any one. They all could be different. Okay, so let's kind of use I'll kind of use me as an example and just kind of walk you through how I was thinking about it, and hopefully that will kind of help you guys think about things. Okay, so first thing, sector. I trade futures, and when I looked at it and kind of dug deep, I found, I'm probably still just too concentrated in stocks. And one way I found this, I did a couple different things, but one thing I did was I looked at the number of strategies that I trade in each different sector. And I put the total number there, and you can see I have a lot more stock strategies than any other market. Energies, metals, and ags, hey, they're not bad, but stocks, wow, I got more of them. And what really makes this bad is a lot of times all the stock ones tend to work at the same time. Where ags, you might have soybeans and coffee and cocoa and cotton, and they're not necessarily all going to move in the same direction, although they could. But it's kind of a little different. So, this is kind of what I saw with my own trading. And you could say, well, okay, well, that was kind of silly. Why did you do that in the first place? Which is a good question. And part of it for me was, well, hey, those stock strategies have been performing really well compared to everything else for a couple of years. And so part of it is you always try to put some extra weight to what's performing well. Well, that kind of came back and bit me, right? Probably bit a lot of you too. And the big problem was, especially after I think that first day, most of my stock strategies started to say, hey, go long, go long. Everybody wanted to go long. And the next day the market kept dropping. That wasn't really good. So you got to be balanced. And that's one of the things you want to take a look at, especially if you trade multiple markets. There's probably some of you out there who just focus on one market, and maybe it wasn't stocks, and so chances are you're probably not even listening to this because that wouldn't apply. But let's just say you were in one market and you always trade coffee, for example, and this sort of thing could happen in coffee. And if you're only in coffee, you're going to be really affected by it. So maybe you got to think about, oh, maybe I should be a little more diversified and try to do some different things. It's much easier for kind of like an automated trader to do that than it is for somebody who's staring at charts and doing discretionary trading, right? Because it's hard to focus on all these different kind of sectors and markets, but maybe if you're doing automated trading, you could actually do that. But the big question is, are you balanced? And my fear for a lot of people is they're not, or they're not as balanced as they think they are. Next thing's correlation. This is a little different than sector balance. This is maybe if you're trading multiple strategies, maybe they're just too correlated. So here's an example. Now I ran this after I had done some analysis to say my strategy, they're not that correlated, but correlation is kind of a goofy thing because you could look over a year, oh, there's no correlation, but you look over a week period, whoa, some weeks are really correlated. And so there's always, well, what's the right time period to look at? And then, well, what's the correct amount? 0.8, anything above 0.8, that means it's correlated. And somebody else will say, no, 0.7. And a lot of people will be like, I don't even know what that number means in the first place. So I went back and looked at it, and the interesting thing I found from some of my own strategies is maybe the correlation wasn't too high, but it cut across a whole bunch of different strategies. So for example, this is one of my ES strategies. So basically there's 11 strategies, and you can see obviously strategy 1 correlates with itself. It's a correlation factor of 1, okay? And if you go over here to strategy number 11, well, it's sort of correlated with strategy 3, sort of correlated with strategy 7, and sort of correlated with strategy 9. So yeah, maybe it's not heavily correlated or, perfectly correlated, but it does tend to act like 3 other systems. And so that got me thinking, of course, this is all after the fact, but like, oh, do I really want that? Do I really want one system that is going to act like 3 others? And, maybe this isn't a good system to have. Maybe I get enough benefit of diversification by just having the other ones. So that's kind of my thinking there. So you want to take a look at your correlation of your systems and how you look at things. You might always, if you're a discretionary trader, you might always be thinking, well, stock market goes up, oil goes up, and so, you trade both of them. Well, they could be pretty correlated. They both they fell a bunch at the same time. So you got to watch out for that. And the point here is, if you're trading multiple different markets or even the same market with different strategies, do you know your correlations and do you know what they mean? And are you happy with what they're doing? And that's a key point to look at. A lot of people fall in the trap, though, of, well, I have an ES strategy and I have a mini Russell strategy, so they've got to be correlated. Well, that's not necessarily true. It's more a strategy issue. If the strategies act the same, that's what brings the correlation. I mean, obviously the markets are the same, but you might have totally different ways of trading those markets where the correlation is low. So you still got to look at it. You got to go beyond just the market. And then, for me, the next thing was the long-short mix. And so here's an example of just a couple of my strategies. And you can see these multiple stops here, and you can see this one actually bought and never got out. Pretty painful. But what do you see here? You just see buy, 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 buy. You never see sell. You never see go short. And that was something I personally didn't pay enough attention to. Even though my strategies, I always had my strategies set up to go long and go short. Because I said, I don't want long only strategies for the stock market because the stock market goes down. Well, that's true. And the way I set it up, yep, I sure could go short. But what I found out is in this situation, almost none of my strategies wanted to go short, which kind of leads back to the correlation issue and those kind of things. But you want to be able to go short, not as easily, but almost as easily as you could go long, because there were some great shorting opportunities here. Take it, what if this, and I did have a couple of strategies that did this, what if instead of a buy here, this was somehow a sell short signal? Wow, that would have been a great trade. So the point is, you probably want to look at this a little bit more, even if your balance is okay, even if your correlations are okay. You still want to take a look at that. So, I've almost always had this requirement, and for people who I've done work with, I always say, hey, you want to go long and short. You want your strategies to go long and short. I despise long only and short only strategies. And a lot of people just say, well, hey, I have long only strategies because the stock market basically goes up. That could get you into trouble, obviously. I mean, everybody kind of realizes that, but just realize even if your strategy can go long and short, that could still get you into trouble too. So it's definitely, for me personally, I didn't feel, looking back on it, I don't feel like, wow, yeah, I really messed up with these strategies. It's just, hey, these strategies just were not designed with this kind of drop in mind. And, looking back on it, well, maybe I need to do something like that. And so again, it's got me thinking, well, hey, this is an improvement I could get, I could do, I could introduce to maybe make it a little faster reacting to some of this short. Now, maybe the way it balances out, maybe that means giving up some of that long side gains. And that's something you got to look at as, is it worth it? And, for a lot of you, maybe, hey, it's not worth it. But for some of you, it's going to be, yeah, I definitely want this sort of thing. Okay, a couple other things that probably a lot of people kind of fell into. Over leverage. Uh, most traders are over leveraged. Simple fact. Uh, you know, if you didn't have any leverage, you probably still would have gotten hurt, but probably not as bad. So you got to look at it. Were you over leveraged? Now I didn't analyze this for me because, well, I did. I just I'm not presenting anything here because I felt no, I don't think I was over leveraged given everything else. I felt those first three issues I mentioned were more my problem, but that's something you got to look at. And if you're the kind of person where you were trading with day trading margins, for example, and you were trading the ES, chances are you're probably over leveraged, and that could be a killer. I was reading somewhere about somebody saying they're basically now they weren't what they were doing was selling some options, and basically now they're I thought it said like $200,000 or $300,000 below zero into their broker, and they were wondering how to get out of that or if they could, kind of thing. Well, that's probably a severe case of just being over leveraged, and so that's something you really want to take a look at and just make sure that wasn't part of the problem. And if it was, okay, well, you got to dial it back. And then the last thing was a lot of people just emotionally lost it. Um, totally understandable. I mean, this was a pretty traumatic event and pretty quick. If it had happened over the course of a month, probably a lot of people would have been better off, right? You would have gotten short signals and you would have got time to think about it. This was this high pressure, oh my gosh, it's dropping, it's dropping, it's dropping, it's dropping. Oh, when's it going to stop? A lot of people had meltdowns. So if you had a meltdown, hey, there's no shame in that, but you got to figure out what you can do to prevent it next time. Because usually when people have meltdowns like this, they start to make bad decisions. And it's usually a decision, I'm getting out of this. I'm just giving, you throw in the towel and you exit everything, and the market bounces back. And you actually saw that during one of the days where the market, I think, hit a double bottom and then immediately just took off in the other direction. Well, that was kind of, a lot of people just kind of threw in the towel. I'm done. That's it. And then the market said, okay, now it's time for me to bounce up. So those are some other things to look at. And that's a big one. Whether you're trading discretionary, you're trading automated, no matter how, people always say, well, hey, I'll trade automated and I won't have any kind of emotions. Yeah, that's not true. It's money. Or as Adam was saying on Tuesday's webinar, he said, well, you'll have emotions because you're human, no matter how you trade. I tend to think of it as you'll have emotions because it involves money. And we've got this distorted view of money where, hey, I'm losing money, and people just start to panic because your ego's kind of tied up with it. But that's a big one. So, if this was a problem for you, again, you go back, did you follow your plan, if you even had one? And, can you deal with the stress of trading? And if you can't, you got to figure out why and come up with some solutions, or don't trade. Maybe you decided after this, trading's, maybe it's not for me because I can't handle this. Hey, that's good. I mean, yeah, it costs you money to figure that out, but if you walk away from trading, it probably means you're not going to have this kind of issue again, or If it's you were stressed out and it was because it was so much money, maybe your size is just too much, and so maybe you just reduce your size, which also then goes back and helps with your leverage. The point is, you gotta kind of, spend more than a minute, spend some time figuring out why you had these issues, or even if you had them. Now, if you just followed your system and followed your plan, and your plan didn't work out, well, okay, you can fix that. Then maybe you don't have to worry as much about the psychological part of it. So there's a couple keys here, obviously. Got to figure out what went wrong. Why did you lose money? Or why did you make money? And people, wait, if I made money, how can that be wrong? Well, it can be. I'm reading a good book now by Annie Duke, and she was a poker player, and it's talking about betting and poker and that kind of, but it's not really a poker book, but a lot of it applies to trading. But one of the things that she talks about was a couple Super Bowls ago when you guys probably remember it, when the Seahawks were playing the Patriots, and the Seahawks had 1st and goal, and there was a little time left, and I think it was on 2nd down, they threw a pass which was intercepted, and they lost the game, and everybody said, oh, hey, you had a bad outcome, therefore that was a bad decision. Well, it's not necessarily true, and it actually turns out that was probably a really good decision to make that play. It's just the outcome was bad. So and some of you are probably like, what in the world is he talking about? Well, just remember the outcome. You got to divorce the outcome from the actual decision, because good decisions don't always mean good outcomes. So when you go to this first point and figure out what went wrong, it could be because you made money too. So it's not necessarily the outcome being bad. Well, once you find out what went wrong, you get some solutions. Easy enough. And like I said, don't be too specific. Try to be as general as you can to really get that big overarching theme. So for me, okay, too many stock systems. Maybe you want some new systems that go short quicker, that kind of thing. Then you can test it, especially if you do back testing and that kind of thing. You just got to watch out for hindsight, because everything looks great when you test it. And, people just keep testing until they get it right, and that's not a good way to back test. But you do some objective testing the right way, then you go and you implement it and see where it goes. And it might be you think it's a great solution, and maybe a year from now, maybe 6 months from now, maybe tomorrow, you'll find out it wasn't such a good solution, or maybe it was a great solution. But again, it kind of goes back to that circle that you got to take some action and then wait for your next problem, right? There's an arrow up at the top. It's always assuming that you're going to have another issue at some point. And a lot of people like to think, hey, I figured this trading stuff out and I don't have to worry anymore. I just keep doing what I'm doing and it's always going to work. And eventually I can just retire. There's almost no place that works like that. There's no career industry, nothing in life really works that way where you can just figure it out and then that's it. You have to keep doing this cycle of, hey, problems come up, now I got to fix some more things and that kind of thing. And that's all part of it. It's not necessarily a bad thing. So just some keys and wrapping up, and then we'll get to the book giveaway and we'll answer some, I'll stick around and answer some questions. just plan on weird things happening in trading, and I just named a bunch of them: Trump getting elected, the Brexit vote, the Swiss bank uh, depegging, this out of the blue meltdown. Weird things happen. You just want to try to set yourself up that if something weird happens, you'll be able to survive it. And you do that, you got to constantly look at how you're trading, what you're trading, how you're doing it. Look for weak points, Trust me, hedge funds, banks, all the professionals out there, they're doing this all the time. And they probably have a lot of very sophisticated risk analysis tools. And, one of the things they found in 2008 was a lot of their risk analysis tools weren't that good. So they were doing key number 2. They were analyzing the trading, but they were analyzing it with a bad tool. Well, they found that out, and so now they improved it. And that's all part of that plan, do, check, act, PDCA. Just continuously improve and try to improve and think about that. That's kind of the way to look at it. All right, so let's give away a copy of the book. I'm going to do what Big Mike used to do and just list one thing you learned today. And I can't see who's typing those in, so maybe Terry, you can tell me the 4th person who.
Kevin, are you there?
Yeah.
Okay, hey, I made you an organizer. You should be able to look at the questions box and view them.
Okay, so let's see. I've got 1, 2, 3, 4. So we've got Danny S. Looks like you
Yep.
are the winner. So Danny, just if you could send me an email, I'll just type the email real quick and then I'll type it in the chat box and just tell me where to send the book and I will do that. And so thanks. A lot of people answered, so at least some people were listening. And Terry, if you want to take back, make yourself the organizer again.
All right, hold tight. I was also able to grab Danny's email, so I'm going to send that to you as well.
Okay, perfect.
Okay, there we go.
Okay. Yeah, so some of the things that you could have written: it's okay to lose, constantly improve. People mentioned reducing leverage, diversifying, all sorts of things. Yeah, there was hopefully people learned something today. So it looks like you did. So that's great. So congratulations. And with that, I think that's all I had. And we can just turn it over for questions, and I can stick around for a while.
Okay.
And
Let's see. What kind of correlation measurements do you recommend? Daily profits, hourly profits?
that's a good question. I can tell you what I look at. I use weekly results, and I look at the period over the whole time, the whole period of my walk forward back test. So that might be a number of years. And then I'll also look at it over a period of a year. That seems to be pretty reasonable to me. Now, if you're doing some intraday systems, so for example, I would go to a much lower level. I'd probably look at daily, or you could actually even look at hourly if you have that data. It's more a function of what your strategies do. So for me, most of my strategies are last days to weeks. So I felt, hey, over the course of a year, how correlated are these strategies? Because there's definitely going to be times where your strategies are correlated. Let's just say you have two ES strategies. Well, chances are there's going to be a fair bit of time where they're both long, if they're both profitable strategies because the stock market's going up, right? And so you got to kind of take that into consideration too, to realize that just the sheer fact that they're both in an uptrending market, you're probably going to be correlated somewhat. So hopefully that's a good answer. I mean, there is no right answer that says, oh, you must use 3 months or 6 months. But, one thing I know, one thing I've looked at doing, and I don't do it right now, but you could actually look at different time frames and just take the maximum. So maybe look at 3 months, 6 months, 1 year, and look at the correlation and what's the maximum of all those, and maybe use that as your comparison and go with that.
Okay, perfect. Thank you. Due to traditional IRA rules, I cannot short. I use inverse ETFs in this situation. Any thoughts?
The one thing I would look at with some of those inverse ETFs or leverage ETFs, just make sure you know what exactly they're doing and some of the rules. And the reason I bring that up is XIV, which was the ETF that just kind of went under. It was short volatility. And what happened was, in its prospectus, I think they had something to the effect of, hey, if volatility in a day, or I think it was in a day, goes up 100%, we can shut down the whole fund. And that's what they invoked, and that's why you saw the price go literally from, I think the close, I think this was on Monday, last Monday, where the close was like a 90, and then in the aftermarket it just plummeted, and the next day when it opened, it was like at $4. So if you're doing some of those inverse ones, make sure you understand what they're doing, and it gets even more so with the leverage ones. I don't do so much of those inverse ones because I don't really actively trade ETFs, so I'm probably not the best person to answer, but that's the kind of thing I'd be looking at.
Okay, thank you. Is it okay to get off the water when you see a storm coming in the markets and just shut down your trading?
It sounds like a boater who asked that question. I'm having trouble answering this because part of me wants to say don't do it, but part of me knows that psychologically that might be a real good decision to make. So I'll tell you what I personally don't do it. So let's just go back, and we knew Brexit was coming, or at least the vote, right? I kept all my systems running. I got hammered and then eventually made it back. The whole U.S. election, I knew it was coming. Again, I got hammered. This particular event, I didn't know. I don't think a lot of people knew, other than on a big scale, oh, hey, the market's due for a correction, but people have been saying that for years. So I'm kind of the opinion just to plow through. But at the same time, I'd probably be better. I know I'd be better off overall had I just turned things off. So you got to kind of balance the two. And maybe it doesn't become just a monetary decision. It becomes an emotional decision that, hey, I'm just going to turn everything off because I don't know what's going to happen. The best way for like a systematic trader to do that is to try to go back through history, which really becomes hard, by the way, and identify events like it that, hey, I would have turned it off then. So maybe it's every presidential election I would turn it off, and then go back and test and see how you came out. Or every Fed meeting, I'm going to turn my system off for an hour before the Fed meeting until 2 hours after. And then you go back and, assuming you can get all the dates of the meetings and stuff like that, go back and test that and then see what happened. But like I said, that will tell you money-wise, oh, hey, you would have saved money, or you would have lost money by doing this. But a lot of these storms become more emotional than anything. And so if that's what drives you, and you can live with the fact that you might be wrong and you might have given up a good opportunity for safety, well, then that's probably a good decision too. So there is no real right answer.
Okay. How do you keep multiple strats on the same asset, say crude, from bumping into one another and buying at the same time, thereby taking too many Ks? Would you just treat this as a correlation issue?
Well, yeah, I don't, other than the correlation part of it, I don't really do anything in particular to prevent that. Because my approach is you test crude oil system A. Oh, it looks pretty good. Okay, I'm going to trade that. You look at B. Okay, that looks good. There's going to be times where both A and B fire, maybe not the exact same time, but pretty close. And you're going to be double long, right? Or double short. And there's going to be times where one's long, one's short, so you're really flat. And I try to just live with that. And I think, going back to some of my own issues that I don't personally like, I didn't like it when I had like 8 or 9 of my ES systems all firing long, basically at the same time. Because all of a sudden, I had all these ES contracts in my account, which that's kind of what partly caused me to be hurting, right? So you can look at it as a correlation issue, but there are going to be times where those add up. And what I do is I look, okay, well, let's say they all my crude oil systems go long. How long can I be? And do I feel comfortable with that? The downside to that is that might be a rare event. It might only happen maybe one day a year. But, that's something you should look at and see, well, okay, could you handle that? Because a lot of people would tend, yeah, I'll trade 5 different crude oil systems, but man, they all go long, and one, you can get caught on the wrong side, and 2, you can kind of freak out because all of a sudden now your size is a lot bigger than you're used to. So hopefully that kind of answered that question.
Okay, we are getting close to time, so I'm going to make this the last question. What about using a filter to determine market trend and then not taking positions against that, and thinking about how you don't like a strategy that only goes in one direction?
You could definitely do that. I mean, it's just, does it test? How does it test? That's the ultimate thing. I mean, a lot of people use for mini S&P, for example, only trade in the direction of the 200 period moving average, or like the 200-day moving average. Hey, that's cool. You say, hey, the long-term trend's up, so I'm only going to go long. Well, that's great. But that particular thing would not have helped you last week because the price was probably still above the 200. I don't even know. I don't even look at that. But and you might have thought, well, man, now I really should be going short. But your system said, no, you shouldn't go short. So that's what you got to kind of watch out for. But certainly what I would do with any of those type things, if you start looking at market regimes of, hey, this is a bull market, bear market, a volatile market or not, test it. That's really the ultimate. If it tests well, then maybe that's something you want to do.
Okay. Thank you for the webinar today, for the information, and for spending some time with us this evening, Kevin.
All right. Well, thanks, Terry, and thanks to everyone. And if you come up with some questions afterwards that I didn't answer, there's my email address. Feel free to email me and just say, hey, what do you think of this? And I'll try to answer you.
All right, sounds good. Thank you.
All right. Thanks.